The US dollar is weakening. Rate cuts are back on the table. And suddenly, stocks, gold, and commodities are all moving fast. But here's the real question. Is dollar weakness about to ignite the next big rally? Or is it quietly signaling trouble ahead? Because when the world's reserve currency starts slipping, everything reprices. Today, we're breaking down exactly what US dollar weakness and Fed rate cut bets mean for stocks, gold, oil, and the broader commodities market. And most importantly, what it means for your money. Let's get into it. Why the dollar matters more than you think. Before we dive into charts and predictions, we need to understand something critical. The US dollar isn't just another currency. It's the global reserve currency. It's how oil is priced. It's how global trade is settled. It's what central banks hold in reserves. So when the dollar weakens, it doesn't just affect travelers going to Europe. It impacts US stocks, gold and silver prices, oil and energy markets, emerging markets, corporate earnings, inflation. Everything is connected. And right now, the conversation in markets is shifting toward one theme: Fed rate cuts. The Fed rate cut narrative is back. Over the past year, the Federal Reserve aggressively raised rates to fight inflation. That strengthened the dollar significantly because higher interest rates attract global capital. But now, markets are increasingly pricing in rate cuts. Why? Inflation has cooled from peak levels. Economic growth is slowing. Corporate earnings are softening. Consumer debt levels are rising. When investors believe rate cuts are coming, bond yields typically fall. And when yields fall, the dollar often weakens. Because here's the basic formula. Higher rates are stronger dollar, lower rates, weaker dollar. But here's where it gets interesting. Markets don't wait for rate cuts to happen. They move on expectations. And that expectation shift is already influencing stocks, gold, and commodities. Pause for a second. If the Fed hasn't even cut rates yet, why are markets already reacting? Because markets are forward-looking. They price in what they believe will happen 6 to 12 months ahead. That's why this moment is so critical. Dollar weakness in stocks. Bullish or dangerous? Historically, a weaker dollar can be bullish for US stocks. Here's why. 1. US multinational companies earn money overseas. 2. When the dollar weakens, foreign earnings translate into higher dollar profits. 3. That boosts reported earnings. For example, if a company earns $1 billion in Europe and the euro strengthens against the dollar, those earnings are worth more when converted back into dollars. That's good for tech giants, industrial exporters, consumer brands with global footprints. But it's not always that simple. A weakening dollar can also signal economic slowdown or policy easing because growth is deteriorating. So the key question becomes, is the dollar weakening because growth is stable and inflation is falling? Or because something in the economy is breaking? That distinction matters. Part 4, gold's reaction to dollar weakness. Now let's talk about gold. Gold and the dollar have an inverse relationship most of the time. When the dollar falls, gold often rises. Why? Because gold is priced in dollars globally. If the dollar weakens, it becomes cheaper for foreign buyers. Global demand can increase. Investors seek inflation hedges. Add in rate cut expectations, which lower real yields, and gold becomes even more attractive. Remember, gold doesn't pay interest. So when interest rates fall, the opportunity cost of holding gold decreases. That's why rate cut cycles often coincide with gold rallies. But here's something many people miss. Gold doesn't just move because of inflation. It moves because of real yields. Nominal yields minus inflation. If inflation stays sticky while rates fall, that's rocket fuel for gold. Let me ask you something. If the Fed cuts rates aggressively, does that automatically mean gold skyrockets? Not necessarily. If rate cuts happen because of a deep recession, liquidity stress, or credit crisis, gold may spike, but so might volatility across all assets. Context matters more than headlines. What about silver and industrial commodities? Silver is more complex than gold. It acts as a precious metal, an industrial metal. So it responds to dollar weakness, rate cut expectations, industrial demand, manufacturing cycles. If the Fed cuts rates because growth is slowing significantly, industrial demand may weaken. That could pressure silver in the short term. But if rate cuts support economic stabilization and the dollar weakens meaningfully, silver can outperform gold due to its higher volatility. Then we move to oil and commodities. Oil is priced globally in dollars. When the dollar weakens, oil becomes cheaper for foreign buyers. Demand can rise. Prices often get upward support. The same applies to copper, agricultural commodities, and other globally traded resources. A weaker dollar can create a synchronized commodities rally. The stock market rotation effect, dollar weakness, and rate cut expectations don't impact all stocks equally. Here's what typically happens. Growth stocks benefit from lower rates. High debt companies benefit from lower borrowing costs. Cyclical stocks respond to economic outlook changes. Defensive sectors behave differently depending on risk sentiment. If rate cuts are seen as insurance cuts, meaning the economy is stable but slowing slightly, markets often rally. If rate cuts are seen as panic cuts, meaning the economy is deteriorating quickly, markets can become volatile. This is why investors must watch labor market data, inflation reports, bond yields, corporate earnings, because the story can shift quickly. Right now, markets are optimistic about rate cuts. But what if inflation reaccelerates? What if the Fed delays cuts? What if geopolitical tensions strengthen the dollar again? Markets can reverse fast. This isn't a one-direction trade. Emerging markets and global effects dollar weakness doesn't just affect the US, it has major global implications. Emerging markets often carry dollar-denominated debt. When the dollar strengthens, their debt becomes more expensive to service. Financial stress increases. When the dollar weakens, debt pressure eases, capital flows into emerging markets, global liquidity improves. That can create a ripple effect. Stronger global equities, higher commodity demand, improved risk sentiment, so dollar weakness can fuel a broader risk on how environment. But again, it depends on why the dollar is weakening. The bond market is the real signal. If you really want to understand what's happening, watch bonds. The bond market often moves before stocks. When investors pile into bonds, yields fall, rate cut bets increase, the dollar can weaken. But if yields fall because growth expectations are collapsing, that's a different signal than yields falling due to controlled disinflation. This is why monitoring the 10-year Treasury yield and real yields is essential. They often dictate gold what's direction, the dollar-s strength, equity valuations. So what should investors be watching now? Here, as your checklist. 1. Inflation data, CPI, PCE. 2. Fed statements and dot plot projections. 3. Treasury yields. 4. Dollar index trends. 5. Corporate earnings guidance. 6. Commodity price momentum. If inflation continues easing and the Fed signals gradual cuts, that's potentially supportive for stocks, gold, commodities. If growth deteriorates rapidly and cuts accelerate, the volatility could spike across all markets. Risks nobody is talking about. Let's balance this out. There are real risks. Inflation could resurge. The Fed could stay higher for longer. Fiscal deficits could pressure treasury markets. Global conflict could trigger dollar safe haven demand. Remember, in times of severe global crisis, the dollar often strengthens, not weakens, because investors rush to liquidity. So the dollar can weaken in easing cycles, but strengthen during panic. That's why narratives can flip quickly. Conclusion: what this all means, let's bring this together. US dollar weakness combined with Fed rate cut bets creates a powerful ripple effect. Stocks can benefit from lower rates and currency translation gains. Gold often rises as real yields fall. Commodities can rally due to dollar pricing effects. Emerging markets may gain breathing room, but everything depends on the reason behind the move. Controlled disinflation and gradual easing, that's constructive. Economic stress and emergency cuts, that's volatile. This moment in markets is pivotal because currency shifts are not small events. They reshape global capital flows. They influence corporate profits. They move trillions of dollars. If you found this breakdown helpful, take a second to subscribe. This channel is all about understanding the forces moving global markets without hype or noise. And now I want to hear from you. Do you think the dollar continues weakening this year, or does it rebound and surprise everyone? Drop your view in the comments. Because in markets, the biggest moves often start quietly. And right now, the dollar is whispering something important. See you in the next one.